So let's get straight to the outlook. The outlook is 1.3 to 1.35. But you are cautious, and you're cautious specifically because of perhaps risks, unforeseen security events. Is your forecasting horizon that constricted these days that you're still not sure with 2 months to go?
Yeah, well, I suppose, Manus, first and foremost, we're retaining the guidance at the 1.3 to 1.35 billion, which I think is a very good performance, underpinned by strong cost control in the business, where we're forecasting costs down 4% on a full year basis. We'd previously guided them down 3%. But you're right, I mean, the airline industry is an industry where you don't have a huge amount of forward visibility. We still have March to go. We haven't got the close-in bookings for that yet, and there is no Easter in March. Yep. So we're guiding fares down as much as 15%, which is great for the travelling public. They've never had cheaper fares than they're getting at the moment, all part of our Always Getting Better programme. But we'll carry 119 million customers in the current year, 94% load factors, which again is another record for Ryanair, and cost control, as I said, in great shape.
You've guided then to minus 15% on fares. Fares declined by 17% in the period you're reporting just gone. Is there downside risk to that 15%? It was 13 to 15%.
It was 13 to 15 for the first half. For the second half of the year. Based on the visibility that we have, we're saying they could be down as much as 15. I can't go into more detail than that.
The cost factor as well. This is now going to be an additional hallmark for you. If I look at Wizz, their costs are flat. EasyJet are rising. You're now looking at ripping costs out of the business at a more aggressive rate than the market had thought. My question to you as a CFO is, where do those costs come from? Are you at the end of being able to extract cost cuts from the business? Because I thought you were going to hug us and make us all, a lot more loved and a lot more welcome.
Are you not feeling love, Manus?
I feel the love from you and Michael every time I walk past a Ryanair brand. But costs are what I want to talk about.
Yeah, absolutely. I mean, costs in the business, this is the key differentiator between Ryanair and every other airline out there. Our next nearest competitor is some 40% higher on their unit cost ex-fuel. And that gap is actually widening. You said they're talking about remaining flat at best, probably increasing their unit costs at a time when we're dropping by 4%. And we're getting these reductions across the business. We've got a lot of initiatives in place as we move forward. You may recall last year we put pay and productivity deals in place with all of our pilots and cabin crew at our 85 bases around Europe for the next 5 years. That's going to deliver great certainty on the staffing line. We're buying aircraft cheaper than we've ever done before. We've hedged our 737-800 programme at a blended rate of 131. We'll be benefiting from the dollar at 123 into next year. And as we look further out, we've got the MAX 200 game-changer aircraft coming in 2019, 8 extra seats, 16% fuel efficiency over the current aircraft. So we've got massive initiatives in place, and then of course our commercial team are working very hard to negotiate good deals with the airports. We're seeing volume discounts coming through. We've just done the Stansted extension.
Yes, and I want to ask you about that, Neil, because I want to talk about Brexit. You said previously that that there wasn't going to be so much expansion in the UK, and then we see this Stansted announcement.
Yep.
So update us on where you see the next move in the UK. Is it going to be more expansion or cutting back?
Well, we've been fairly clear on this. We see ourselves not growing as quickly in the UK as we might otherwise have done. That said, there will be opportunities like the Stansted deal where we're going to grow to 20 million customers.
What's the opportunity there? Is that because Brexit's not been as bad as you thought, or London's very exciting? I mean,
so one of the benefits of what's happening at the moment is that sterling is weaker, so we're getting lower costs from a sterling basis. That helps us with volume discount deals in Stansted to be able to go in there and add an extra 9 routes this summer, places like Naples, Copenhagen, etc., and to grow to 20 million customers. But that said, we still see more growth going into mainland Europe and elsewhere over the coming years rather than into the UK as we pivot away. There's an awful lot of uncertainty around what's going to happen with the hard Brexit or otherwise.
Michael was just the other day talking about a cliff edge. I'm paraphrasing here. He's talking about a cliff edge and he's talking about the no transition deal. When you look at sterling, it's a huge risk for you. When you look at sterling, how much more weakness do you see in that? But does that invert? Are the pickups coming from Europe into the UK? And where's the strongest lift, as it were, coming from?
Well, we've got very strong passenger numbers everywhere. I suppose that's a factor of the kind of Always Getting Better programme that we have and the lower fares that we have. And we'd record 95% load factors in the quarter just ended. So it's across all of Europe. People continue to travel in the UK, but we're stimulating people to travel with lower fares. But as we get closer to Brexit over the next kind of 24 months, we may see a slowdown in the UK economy. And I was interested listening to your last contributor, and this may have an impact not only on the UK but elsewhere. And that's why we have to be cautious in how we grow in this market. And there's a huge amount of opportunities. We only have 15% market share in Europe at the moment, so there's a massive amount of things that we continue to do. Hopefully we'll get more opportunities in the UK. We're not going away.
Are you planning at all? Are you thinking about scrapping UK domestic routes?
We're reviewing it. You know, an awful lot depends on whether the UK stay in the Open Skies Agreement.
Wouldn't you just buy an air operating certificate for the UK?
And this is something that we can do. It's a relatively simple process to do. But if you look at our domestic UK, we've got 3 domestic UK routes out of 1,800 routes that we do in our network. It's a relatively small part of our business. However, if as we get closer to Brexit, it seems that this is a business that we want to stay in domestic UK, then we can, of course, open up an AOC here, an air operator certificate in the UK and operate under that. But that's, you know, this is the contingency planning that we're doing. We're looking at all possible scenarios.
Okay.